and you have, you're only investing a certain percentage of your, your budget or your portfolio percentage on that, and you have a market or an infrastructure of the market that is ready to digest this new company, that with this new, maybe with when we're talking about, for example, Coinbase or even Microsoft, when they were able to really take a hold of Azure and make it do something big for uh, and make it a winner as far as money wise, and really take advantage. Um, when you have, um, you know, I guess Microsoft would be a less great example as artificial intelligence. So artificial intelligence or digital currency, Coinbase rebounding after it would people are starting to really digest it and be okay with it now because there's been some corrections. And the same thing with artificial intelligence. It's going to take some hits if people aren't ready for it. But we think maybe people are ready for some of the initial benefits of artificial intelligence. I mean, we see that by the digestion of, um, even in its infancy here, just being able to capitalize on like Microsoft Copilot and like the Adobe suite that is able to take advantage of it. These big conglomerate entities in the technology space that have been here for, been winners for a long time, and they're taking advantage of the technology right away, even if it in its infancy. We just are touching the very, very surface of what we can do with AI assistance to get our jobs done and do them better. um, it's probably more even at a better spot to continue to grab at that gain now and make money off of it um, than digital currency. Digital currency might be more of a slow burn until we get some more course corrections. So you have to know the market, and is their infrastructure able to swallow it and run with it and make money off of these new things. For example, um, even with Facebook, you know, it first it wasn't right off the bat a big winner as far as how much it can make, but the potential was there. So you could make money. So it made money right away, but not as much money as it made as it got bigger. So you're going to have those highs and those lows, but you have to make sure you know your appetite for risk. If there's a new mania, make sure you look at probably best of breed. You're going to want to look at who you think's going to stay the course, because there's been some digital currency stocks out there, or um, even currencies that you could have invested in that really just took a huge hit right off the bat. And there's some that just lost their shirt. Coinbase definitely took a hit, but they've recovered because of course corrections, market corrections, and they have kind of stayed, like, they have made adjustments where they want to make sure they're complying with whatever federal guidelines are coming out, or they're trying to stay ahead of those guidelines to keep everything kosher and trying to keep everything kind of make sure the accountability is there, even when it's the wild wild west, basically, with digital currency. So if there's gonna be a mania, make sure you pick something that you think can weather the storm, and you're prepared to take dips. Otherwise, stay out of it. Just stay out of it. Just wait until you see that there's a more mature infrastructure to sustain and make money off of that. New sectors basically that are created, and you have to have a business justification for for jumping into any type of new sectors like that. All right, now we have next one would be If you have, a major loss, make sure that to recover your overall long-term portfolio, this is more of a long-term. If you want to recover from, like, say, a 10% loss, you're going to have to make up for it with, like 11% gain, or a correction. If you want to, that is if you expect to recover a certain amount of money that you've lost so that you can keep the same growth rate that you expect. Now, if you're more, if you don't care if you hit those goals, and you just want to make sure that you make good choices after getting hit, or if you know that you just need to get out and move on, sometimes that's the best thing to do, is just cut bait, move on, go to a better investment strategy. Sometimes that happens. But if you're trying to make sure you keep hitting your goals as you grow older, you know, if there's a bear market and there's a 20% loss, you're going to have to probably get a 25% gain to recover what you've lost, because of, counting for typical inflation, or just, you know, getting back that capital over a certain period of time is going to just be a different percentage gain requirement. For example, with a loss of 30%, you're going to need a 43%, um, you know, recovery. 40%, you need about a 67% to recover. That's a big recovery to keep staying on track. So just remember that if you're trying to meet milestones and keep that retirement plan, to if you had a goal, a certain number goal, if you take a big loss, um, you're going to have to account for that. You're going to have to add a higher percentage back to meet that goal in the end. Next up, don't follow the herd. So this is more about thinking about that than the mania. Not so much mania, but um, if there is an artificial intelligence by extravaganza, that doesn't mean you want to sell all the assets you have to get into something just because. Um, you know, because we know that the market goes up and down and there's seasonal gains and losses, you can predict that there's going to be a dip on a new president, American president. Um, elections always causes uncertainty because you got half the country who wants a certain person and half the country who doesn't, and you're going to have to account for there's certain seasonal um, uh, dips and surges when it comes to the market. And if you account for that, you can make sure that you buy on fears, and that um, when it comes down, that's gonna be your go-to um, uh, plan. Um, so, for example, um, some of the best times um, to buy, like I said, is when there's fear. When there's fear in the market, of course, we know that we always want to take advantage of that. Some seasonal patterns might be like before the holidays, before July 4th, before Thanksgiving, before Christmas. We always know that unless there's a pandemic that just totally keeps people at home, then you might want to invest in Amazon, which we saw. Uh, but we know that there's going to be traditional markets. Walmart's going to go up. Um, Retail in general is going to do well. Um, you know, Amazon is always going to do well around Christmas. Um, but you're going to see a lot of retail stores that are going to do well during that time. Um, so that's always that's always something that you want to think about. Um, Unlike the rhythm of the market. I mean, we're talking about whether it's hot or it's cold. If it's hot, there's going to be people are going to be traveling. So you're always thinking about what happens. People go on cruises. People do. I mean, people go on cruises and it's cold, but I mean, there's all kinds of things that happen. People are eating out more. They're going outside. They're doing a lot of things like that that um, create certain market conditions, and it's good to just be aware of that. It doesn't mean you always want to sell just because it's cold or it's hot, but think about that when you're considering selling. Maybe you wait till a certain point and it's going to dip. Then that's not a bad idea. Um, if you think about, an example might be something like Home Depot. Um, so Home Depot, home improvement, spring, summer months, that's usually when there's going to be some renovation, home improvement. And it's not just going to be, you have contractors who are always going to be building and things like that. But when you have on top of that homeowners just improving their house, keeping, doing things that they typically do during the summer months, then it's just naturally going to boost their the demand, and it's going to boost up their price a bit. Um, and then um, there's always going to be things like that that we want to consider when it comes to seasonality. Um, and then, the other things, um, the cycles um, that we also want to be aware of is um, you want to think about um, when it comes to boom bust type of situations. Um, Going back to the presidential example, um, when if there is some type of issue with China, for example, the U.S. relies heavily on China for a lot of Amazon businesses, retail. I mean, you name it. We import all kinds of things. If there's a political mandate by an incoming president to that might, for example, just might increase tariff prices. Now, um, long term, it's going to be a good thing if we can rein in China and say, no, we're going to take a dip right now, and we're going to take a strong stance and say, sorry, but we're not going to let you, you know, um, uh, take advantage of IPO, intellectual property, and just do knockoffs, and then charge us horribly on, um, you know, exporting your goods, and then us not charging you much for things that you want to take from us and buy from us. Um, if we want to take advantage, if we want to put our foot down and say no, we're going to draw a line in the sand now so that we can draw a new expectations long term. That's a good thing long term. Short term, it's going to hurt. So if you know that's coming based upon the certain politics, a certain president, um, maybe you want to take that into consideration when you think about investing in Chinese exporters, for example, or any market that takes advantage of cheap Chinese imported goods to then turn a profit, which a lot of people do. So there's something to take into consideration when you're really evaluating buying and selling, especially in the retail space. That's what we're talking about. Even the big box places. It's all Chinese goods for the most part, unfortunately. So there's a few more top 15. We'll continue this in part 3. So stay tuned.